Hello everyone, and welcome to the fourth webcast on the recently published discussion paper, Financial Instruments with Characteristics of Equity, or FICE for short. My name is Kumar Dasgupta, Technical Director at the IASB. Today, I'm joined by Choi, Technical Manager at the IASB. This is the last scheduled webcast on the classification section of the discussion paper, and we will be talking about classification of compound instruments and redemption obligation arrangements. But as before we begin, a couple of housekeeping points. You can download the slides by clicking on the button below the slides window. This webcast is a recording, so we are unable to take any questions from the audience today. And last but not the least, the views expressed are those of the presenters, not necessarily those of the board or the IFRS Foundation. For those of you who have been following these webcasts, you'll know this is the fourth in the series of webcasts exploring the FICE discussion paper. The topic we will be covering today is compound instruments and redemption obligation arrangements, which is covered in section 5 of the discussion paper. In the first webcast, we provided a brief overview of the discussion paper, covering why the board is doing this project, the scope of the project, and how the preliminary views in the discussion paper compare with IAS 32. In the second webcast, we covered the key parts of the board's preferred approach to classification. We also talked about how the board's preferred approach would classify non-derivative financial instruments and looked at some examples. In the third, we discussed how the board's preferred approach would classify most derivatives on own equity except those that include an obligation for the entity to take back its own shares, which we will cover in this webcast. In coming weeks, we will look at the board's proposals around the presentation requirements for equity instruments and for those for financial liabilities. Before we continue further, let us clarify the scope of section 4 of the discussion paper, which was covered in the previous webcast, and section 5, which we will cover in this webcast. Section 4 is about classification of derivatives on own equity, whereas section 5 deals with classification of compound instruments. So things like convertible bonds that combine a bond and an option to convert that bond into the entity's own shares in a single instrument, and obligations to redeem the entity's own shares, such as derivatives that require the entity to buy back its own shares and to pay cash to do so. In some cases, when accounting for a compound instrument or a redemption obligation, it will also be necessary to consider the classification principles for derivative instruments set out in section 4 of the discussion paper. We will give you some examples of this interaction during this webcast. So, what are derivatives that may require extinguishment of own equity instruments, and why are they treated differently? Generally, if an entity enters into a derivative contract, the entity's financial position will be affected by the net amount of the derivative. However, if an entity enters into a contract to repurchase its existing shares, or to purchase them at the option of the counterparty, i.e. the holder, then the entity's financial position will be affected by the obligation to pay the redemption amount. For example, the fixed amount of cash that it has to deliver at the option of the holder. By entering into such a contract, in effect, the entity has fundamentally altered the characteristics of the existing shares. The entity has promised to pay a fixed amount of cash instead of having the ordinary shares outstanding at the option of the third party, which has similar consequences for the entity's cash flows to that of a typical bond. Consequently, under the board's preferred approach, the accounting captures these economics through the recognition of a liability for the amount of the unavoidable obligation to pay cash. Let's pause and make it clear what we mean by compound instruments and redemption obligation arrangements, as we will continue to refer to them many times in this webcast, and we do the same in the discussion paper. Compound instruments contain both a liability and an equity component. For example, a typical convertible bond that includes an obligation to either pay cash or deliver a fixed number of the entity's own shares at the option of the holder. Consistent with IAS 32, components of compound instruments would be classified separately as financial liabilities, financial assets, or equity instruments. By redemption obligation arrangement, we mean derivatives that may require the extinguishment of own equity instruments. For example, a written put option on own shares. Because the derivative, if exercised, requires the extinguishment of existing equity instruments of the entity would consider the derivative together with the existing equity instruments of the entity for the purposes of classification. Now I will hand over to Uni to take us through in more detail the application of the board's preferred approach to such instruments.
Thanks, Kumar. So one of the things that's covered in the discussion paper is the similarity between convertible bonds and written put options. That similarity might not be immediately obvious, so let's go through the analysis. Let's compare a convertible bond and a written put option on own shares, a form of redemption obligation arrangement. At maturity of the convertible bond, the holder has a choice to either receive 100 currency unit in cash or convert the bond into 100 shares. In case of a written put at maturity, again the holder has a choice either to receive 100 currency unit in cash by exercising the put or retain 100 shares by not exercising the put. In both cases, the economic exposure of the entity is the same, and in both, the entity does not control which settlement outcome will occur. At maturity, the entity will either have to pay out cash or 100 of its own shares will be outstanding. It is this similarity that the board focuses on when considering how to account for redemption obligation arrangements. So now looking at the classification outcomes. Applying the board's preferred approach to classifying non-derivative financial instruments, which is covered in section 3 of the discussion paper, an entity would first identify an unavoidable obligation that has the feature or features of a financial liability, and classify that obligation as a financial liability. In the case of a convertible bond, that it is an unavoidable obligation to deliver 100 currency unit in cash if the holder chooses the cash settlement outcome. In the discussion paper, the combination of the written put and the underlying shares is analyzed in a consistent way as the convertible bond. There is an unavoidable obligation to deliver 100 currency unit in cash if the holder chooses to exercise the put option. Both of these obligations are recognized as a financial liability. Therefore, by writing such a put option on own shares, the entity has created contractual obligations at maturity of the put option that are very similar to those of a convertible bond and has in effect changed the characteristics of the existing shares. Accordingly, under the board's preferred approach, the entity would recognize a financial liability for the present value of the put strike price and would de-recognize 100 shares for an amount equal to their fair value. Stopping for a moment at this point, for both the convertible bond and the written put, for accounting purposes, 100 shares are not in issue. So taking this perspective, the entity would then classify the remaining rights and obligations created by the instrument, which is an obligation to exchange the financial liability of currency unit 100 with 100 shares at the holder's option for both the convertible bond and the written put option. That option is a call option, and that is classified based on the discussion in section 4 of the discussion paper that we addressed in our last webcast. This accounting achieves the board's objective of ensuring consistent classification for financial instruments that have similar contractual rights and obligations. How is this different from IAS 32? For a written put option on own shares, IAS 32 also requires recognition of a financial liability for the present value of the redemption amount. It also requires reclassification from equity. It does not, however, explain why such accounting is required and does not explain what the accounting entry and equity represents. We will chat more about the challenges that arise when applying IAS 32 later in the webcast. Moving now to a slightly different fact pattern, another convertible bond, but this time denominated in a foreign currency. Similar to the previous example on slide 7, for both the convertible bond and for the written put option, the entity would recognize the obligation to deliver 100 foreign currency unit as a financial liability. For a written put option, the entity would also recognize 100 shares. Once that's done, in the case of both the convertible bond and the written put option, the obligation that remains is the obligation to exchange that financial liability for foreign currency 100 for 100 shares. As for the last example, this represents the written call option. The holder can choose to ask for 100 shares in exchange for the financial liability. The entity would apply the derivative classification principle from section 4 of the discussion paper to classify that remaining obligation. In this case, the call option includes a foreign currency variable. The exercise price is a foreign currency. And because a foreign currency variable is a variable independent of the entity's available economic resources, as discussed in section 4 of the discussion paper, the written call option would be classified as a derivative financial liability. This partly independent derivative may be subject to separate presentation in other comprehensive income. We will have a separate webcast in coming weeks to cover those presentation proposals. Accounting for a financial liability component in a compound instrument and an obligation to extinguish on-equity instruments under the board's preferred approach is actually very similar to what IAS 32 requires today. But IAS 32 does not explain the rationale and does not discuss the relationship between these accounting requirements. This has resulted in a number of questions, including why a derivative that includes an obligation for an entity to buy back its own shares should be recognized on a gross basis as opposed to net presentation, particularly if the obligation is to buy back the shares at the fair value. In addition, when recognizing a financial liability for such transactions, IAS 32 requires that the same amount be reclassified from equity. However, IAS 32 doesn't explain further how that reclassification entry should be made, for example, which part of equity it affects. Also, IAS 32 doesn't explain any subsequent accounting. This lack of detail has led to many questions about the accounting for written put option on non-controlling interest, or in short NCI puts. In 2012, the IFRS Interpretations Committee published a draft interpretation that addressed the recognition of changes in the measurement of the liability that arise from NCI put. However, respondents to that draft interpretation suggested that the board should address the accounting for NCI puts more comprehensively. The respondents pointed out that other aspects of the accounting for NCI put have resulted in diversity in practice, including which equity item should the debit be recognized when reclassifying the present value of the redemption amount from equity. More significantly, for NCI puts, the question is whether the non-controlling interest is actually derecognized, or whether a contra-equity account is recognized within parent equity. Also, questions arose on how to account within equity for any premium received for NCI puts and for the expiration or exercise of the NCI puts. The classification principle in the discussion paper will apply the same way to NCI puts as we have seen in example on slide 7 for other written put option on shares. So a financial liability is recognized for the present value of the redemption amount. The underlying shares that represent NCI subject to the put are derecognized at the amount of the then fair value of that non-controlling interest. And the remaining obligation, that is the obligation to exchange the redemption liability for shares, would be recognized for the difference between those amounts, Subsequent accounting will be consistent with how a written call option will be accounted for. The liability recognized for the redemption obligation will be accounted for applying IFRS 9. If the strike price is the fair value of the non-controlling interest, the discussion paper proposes that separate presentation of income and expenses related to that liability would be required. We will cover this more in detail in one of the upcoming webcasts. What about contingent convertible bonds? For example, take the case of a bond issued by a bank that has periodic obligation to pay a coupon and to be repaid at maturity like a typical bond. But in addition, the bond is mandatorily converted into 100 shares of the bank if the bank's regulatory capital ratio falls below a specific threshold. If you look at the potential settlement outcome, the bank can be required to deliver either 100 currency unit in cash or 100 shares, similar to a convertible bond or a written put option on shares we have looked at previously. The difference is that in the case of a contingent convertible bond, the settlement outcome will be determined based on the occurrence or non-occurrence of a contingent event, whereas in a convertible bond like the example on slide 7, the holder chooses the settlement outcome. Applying the board's preferred approach, if a financial instrument does not give an entity the unconditional right to avoid a settlement outcome that has the feature of a liability, it would give rise to a financial liability of the entity, and that is regardless of whether the settlement outcome is controlled by holder or is determined by an uncertain future event that is beyond the control of both the entity and the holder. Examples of such contingent events include events completely unrelated to the entity, such as the level of share market indices or commodity prices, but also events such as changes in the entity's future revenues, profit or loss, financial ratios, or own share price. For both the bond that can be converted into shares at the holder's option and this contingent convertible bond, the entity has an unavoidable contractual obligation that has the feature of a financial liability. Under the board's preferred approach, the entity would recognize the obligation for the full present value of the redemption amount as a financial liability as if it is unconditional. Any effect of the conditionality would be included in the derivative representing the potential exchange of that liability for shares. The entity would then apply the derivative classification principle to the remaining obligation, being the obligation to issue on shares in exchange for the liability. In this example, the obligation that remains after recognizing the financial liability for redeeming the bond is the obligation to exchange the right to cash for delivering 100 shares. Assuming no independent variables, as the bond is denominated in the entity's functional currency, the derivative would be classified as an equity instrument. Questions have also arisen about whether contingent conversion features that are required by law or regulation are relevant to determining classification. Consistent with IAS 32 and IFRS 9, the classification of a financial instrument would be based on contractual terms of the instrument rather than laws or regulation outside the contract. This topic is covered in section 8 of the discussion paper. I will now hand it over back to Kumar.
Thanks, Uni. Let us consider the last example that we want to cover in this webcast, and it is the example of a financial instrument with alternative settlement outcomes. This time there is one significant difference from the examples we have discussed so far. The entity controls the settlement outcome instead of the holder or a contingent event outside the control of both the entity and the holder. Suppose that an entity issues a so-called reverse convertible bond. At maturity of the bond, the entity may choose either to repay currency units 100 in cash, or alternatively, the entity may choose to convert the bond into shares by delivering 100 shares. The entity has the obligation to settle the bond in one of two ways, but the entity has the unconditional right to avoid the liability settlement outcome by choosing to deliver 100 shares. such a financial instrument can be analyzed as containing an obligation to deliver 100 owned shares and a right, not an obligation, a right of the entity to extinguish that obligation by choosing to deliver cash instead. Applying the board's preferred approach, the entity would classify the bond as an equity instrument in its entirety. Because going back to the basic classification principles, the entity does not have an obligation to pay cash or to deliver an amount that is independent of its own performance. The board considered whether, and if so, how the information about the entity's right to choose the alternative settlement outcome can be provided. That is, the fact that the entity has the right to pay currency units 100 instead of delivering 100 shares, which is similar to the contractual rights in a purchase share call option. It is important to note that like IAS 32, if the instrument were set up so that the entity was effectively compelled to always choose to settle in cash, then a different analysis will apply. But for the purposes of this example, we have assumed that isn't the case. The board discussed potential ways to provide information about the alternative settlement outcome in this case, because the simple equity classification doesn't tell the whole story about the instrument. The alternatives discussed include separation of embedded derivatives from the equity host instrument, and through presentation and disclosure, such as attribution within equity. The board did not form a preliminary review and decided to seek feedback through the discussion paper. Before we close, we provide on this and the next slide a classification comparison between IAS 32 and the board's preferred approach for the types of instruments we have been discussing in this webcast. Please note that while the form of settlement varies as described, the derivative in each case involves a fixed functional currency leg and a fixed number of own shares leg. So none of the examples have the net amount affected by any variable independent of the entity's available economic resources. As we have gone through using our examples on slide 7, a written put option on own equity will require recognition of a financial liability, the recognition of own equity instruments at their current fair value of that equity on the date the put option is written, and accounting for the residual obligation as a written call option. Recognition of a financial liability and having a corresponding entry in equity is the same as the requirements in IAS 32. What the board's preferred approach clarifies is that the shares are derecognized, specifies that they occur at the then fair value of those shares, and how to account for the obligation that remain after recognizing a financial liability and derecognizing own shares. The same accounting will apply if a written put is settled net in shares, because such an option may require extinguishment of the entity's own shares. For a forward contract, the entity would recognize a financial liability for the present value of the redemption amount and derecognize own equity at the current fair value on the date the entity enters into a forward contract. Unlike a written put option, a forward contract does not involve an alternative settlement outcome, and no further obligation is therefore recognized. What we have done in this webcast is to provide an overview of Section 5 of the discussion paper. In upcoming webcasts, we discuss how presentation of financial liabilities and equity instruments can provide additional information about financial instruments to supplement information provided by classification. That brings us to the close of this webcast, and thank you for listening, and we hope that you found it useful. Stay tuned for more webcasts in the coming weeks.